Welcome to The Explainer. Today we are doing a technical deep dive into one of the biggest audit red flags for anyone filing Form 8829 for a home office. We're talking about the line between a simple repair you can deduct now and a capital improvement you have to write off over decades. And trust me, getting this wrong can be a very expensive mistake.
So this is the big question, right? Repair or improvement? It seems simple, but for any serious taxpayer with a home office, this is a huge compliance challenge. And it's not about what you feel is right. There's a rigid, objective framework you have to follow.
And the stakes, they couldn't be higher. Get it right, and under Internal Revenue Code Section 162, you deduct the cost this year. Money in your pocket, right now. But get it wrong, and under IRC Section 263A, you have to capitalize that cost and stretch the deduction out over a painful 39 years. You could be looking at penalties or just losing the value of that money for almost 4 decades.
So to figure this all out, we're going to use what I call a diagnostic funnel. It's a step-by-step framework that's going to walk us through the whole analysis, from the big picture ideas right down to the nitty-gritty tests you have to apply to stay out of trouble.
Okay, let's get into it. The entire issue really comes down to this tension between two parts of the tax code we just mentioned. You've got Section 162, which says go ahead and deduct your normal business expenses, and then you have Section 263A, which says, whoa, hold on, you can't deduct costs that make your property better.
Now here's something you absolutely have to understand. Since 2014, this isn't just a judgment call anymore. The IRS came out with the Tangible Property Regulations, we call them the TPR, and they created a mandatory objective set of rules. You have to follow these specific steps. The old way of just winging it is over.
All right, so let's move to the first and honestly the most critical step in our diagnostic process, figuring out exactly what asset you're working on. This is the foundation for everything else that follows.
This idea is called the unit of property, or UOP for short. And simply put, it's the specific thing you measure an expense against. And here's the kicker. The IRS doesn't see your house as one single thing. And the smaller your unit of property is, the more likely it is that your expense is going to have to be capitalized.
In fact, under Treasury Regulations Section 1.263A3E, the government says your building is actually broken down into these 8 separate building systems, plus the building structure itself. Each one of these, your HVAC, your plumbing, your electrical, is its own separate unit of property.
Okay, I know this might sound like we're getting into the weeds here, but this detail completely changes the game. Why does it matter so much that your house is broken up into all these little systems?
Well, here's why. Because you can no longer say that replacing your central AC unit is just a minor repair compared to the value of your entire house. Nope. What you've actually done is replace a major part of the HVAC system UOP. And under the rules, that is a capital improvement, period. It has to be depreciated.
Now, before you have to wrestle with all these complicated capitalization tests, the regulations give you a few procedural off-ramps. These are called safe harbors, and they can end your analysis right then and there, letting you deduct something that might otherwise have to be capitalized.
There are 3 main safe harbors you need to know about, and you really need to check them in order, because you always want to find the easiest way to get to that immediate deduction. First up is the de minimis safe harbor. You can find it in Regulation 1.263A-1F. Now, if you don't have something called an applicable financial statement, and let's be real, most home office filers don't, you can choose to just expense any single item on an invoice that costs $2,500 or less. You just have to make sure you make the proper election with your tax return.
Okay, now this is probably the most powerful tool for people with a home office. It's the safe harbor for small taxpayers. Look at the criteria. If your business's gross receipts are under $10 million, the original cost of your home is under $1 million, and your total repairs for the year are less than both $10,000 and 2% of your home's cost, you can elect to deduct expenses that would absolutely be considered capital improvements otherwise. It's a huge deal.
So what happens if none of those easy off-ramps apply to you? Well, then you have no choice. You have to go to the final step in our funnel and run your expense through the 3 big capitalization tests: Betterment, Adaptation, and Restoration. You can just remember them as the bar tests.
So first up is the Betterment Test. This is from Regulation 1.263A-3J. And it's basically asking, did this work materially improve the unit of property? Did it fix a major problem that was there when you bought the place? Did you add something new? Or did you make it significantly more efficient or better quality?
Let's make this real with an example. Say you fix one broken window. Well, that's just keeping your house in working order. That's a classic repair. But what if you replace all your old, drafty single-pane windows with brand new, energy-efficient triple-pane windows? See, that's a material increase in the building's efficiency and quality. That's a betterment.
Next up, we have the Adaptation Test, which is under Regulation 1.263A-3L. This one's actually pretty simple. It gets triggered anytime you change the fundamental use of a space.
And the textbook example here is taking your unfinished garage, a place that was built to park cars, and converting it into a finished, insulated, livable home office. Every dollar you spend on that conversion, framing, drywall, electrical, everything, has to be capitalized as an adaptation because you've changed that space to a completely new and different use.
And finally, we have the Restoration Test from Regulation 1263A3K. Now, this is the one that trips up most homeowners, because it's all about replacing significant parts of your property. And that brings us right back to our old friend, the unit of property analysis.
So, let's talk about the roof. If you patch a small leak after a storm by replacing a few shingles, that's a repair, no question. You're just keeping it working. But if you replace the entire roof covering, that's a restoration. And why? Because the regulations say the roof covering is a major component of the building structure, UOP. You've restored a huge part of that asset, so you have to capitalize it.
Okay, so after going through all that, it's so important to understand the final outcome, because the financial difference between calling something a repair versus calling it an improvement is, well, it's absolutely massive.
Here's the deal. Under the tax code, the business part of your home is considered non-residential real property. That means any cost you have to capitalize as an improvement doesn't get deducted right away. Oh no, it gets depreciated over 39 years. To put that in perspective, a $10,000 improvement gives you a tiny deduction of about $256 a year.
And this all leads to a huge strategic choice every single person with a home office has to make. Do you take the time to master this complex world of UOPs, safe harbors, and BAR tests so you can maximize every possible deduction? Or do you play it safe and just take the simplified method, which totally eliminates this audit risk but caps your deduction at a flat $1,500 a year? There's no one right answer. It completely depends on your own situation.